The European Central Bank lowered its interest rates by 25 BP yesterday, in a widely expected and priced-in move. Chief Christine Lagarde highlighted that inflation is coming under control, warned that there could be a temporary uptick, but the figures will be sustainably back to target by next year and that the Eurozone will unlikely enter recession. It was rather a dovish cut. Note that the bank said that it will maintain its meeting-by-meeting data-dependent approach in place and is not committed to a particular rate pattern, but the bank's confidence that inflation is being tamed, and the morose economic data boost the probabilities of further rate cuts from the ECB in the coming meetings. The expectation now is that the ECB will cut its rates at every policy meeting until March. Next stop, December. As such, the euro sold off after the ECB decision. The single currency is preparing to test the 83 cents level against sterling, which has also been weakening this month on rising Dovish Bank of England expectations and softening British inflation. The October budget is causing some weakness in sterling, but the outlook remains more bullish for sterling than for the euro. The 82 cents level now seems within reach, under the condition that the autumn budget doesn't trigger chaos by the end of the month. Against the US dollar, the euro extended losses to 1.0811 yesterday and is consolidating near the 1.0840 level this morning. But some of the weakness could also be attributed to the strength of the US own economic data that showed some stronger than expected retail sales in September, a bigger than expected jump in Philadelphia Fed's manufacturing index and jobless claims in line with expectations. Atlanta Fed's GDP now forecast will be revised today, but the forecast already points at a 3.4% growth in the US GDP for Q3, screaming that the Federal Reserve's 50 BP cut was probably unnecessary last month. Somehow, none of the good news derails the Fed cut expectations for the November meeting.